Being a financial advisor in the greater Seattle area means that I have quite a few clients who are either high income earners and they're accumulating their wealth, or they're people who've done a good job saving for retirement and have accumulated a lot of wealth and now they're looking forward to retire. Every single one of my clients feels the sting of taxation, and every one of them thinks they pay a whole bunch in taxes, and that's true. The number that they pay in taxes, the actual dollar amount, typically is pretty high. What a lot of them don't believe is that historically they're actually getting a pretty good deal. So we'll look into it a little bit here, but the bottom line is that from a historical standpoint, we're actually in very low income tax times in this country. So a lot of the tax planning in my practice revolves around how do we minimize the total amount of taxes that somebody pays over their investing lifetime so that their retirement can look how they want it to look. The bottom line is that you're either saving for Uncle Sam's retirement or you're saving for your retirement. The decisions you make now can mean hundreds of thousands of dollars, and whether or not those dollars stay in your pocket or go to Uncle Sam is dependent upon the tools that you use now to plan for your future. So if I haven't met you yet, my name is Chris Reed and I'm the owner of Capital Partners Wealth Management, and I make these videos because I know that money only matters because it allows us to do the things that we want with the people we care about, and ultimately a little bit of difference goes a long way. If you find these videos useful, I always try and put some links below with resources that might allow you to strategize or plan your finances a little bit better so that you can do things like minimize the amount of taxes you pay and maximize your retirement. So when we go to everybody's favorite financial planning tool, google.com, and we take a look at the historical tax rates of the United States, every chart looks pretty similar. And they're all telling the same tale, which is back in the 1940s and 50s, the top marginal tax bracket used to be almost 95%. And today the top marginal tax bracket is 37%. So from a historical standpoint, we're actually paying about a third of our all-time highs on every dollar that we earn. Again, this is in that top marginal tax bracket, but the concept still applies to every tax bracket below that. The next data point that I have people consider is our national debt. So the way Congress does their accounting, they're not actually even required to account for our national debt via standard accounting practices. They're allowed to use some budgetary trickery. So this number could actually be a lot worse. So when I take those two data points in conjunction, and that's taxes having been at all-time highs and now being at almost all-time lows, and our debt having gone up exponentially through the roof, the real question that we have to consider when we're deciding on how we save our money for retirement is, do we want to pay taxes here in 2023 next year? Or do we want to bet on where taxes are going to be in 2043 when we go to take the money out of those accounts? So if this number goes up and up and up over time, and you end up finding yourselves in a 2 to 3 times higher tax bracket, even if you go by the old school financial planning of, well, I'm going to make less money in retirement, right? So even if you plan on making less overall money in retirement, there's still the potential to pay a lot more in taxes down the line. So how we mitigate that and how we reduce the amount we have to pay overall is by choosing today which investment vehicles we use to invest our money. So every dollar that your employer gives you can either go into a pre-tax bucket, and these are your 401ks and your IRAs, your SEPs, your Simples, and your other pre-tax vehicles. So when that happens, your money skips the tax man today. So if we're putting $20,000 a year into our retirement buckets, that money is going to go straight in there without having any taxes taken out. But when this money comes out to go to you in your retirement, you actually have to pay the IRS. So if we're saving it in 2022 and we're not paying taxes, but that money's coming out in 2042, you're going to have to pay whatever taxes Congress tells you you have to pay 20 years from now. The other way we can save that money is by putting it in tax-free growth or post-tax. So that money would go into this bucket. Now this is the Roth, and you can get to the Roth by doing straight Roth contributions depending on whether or not you're saving into a Roth 401k or a Roth IRA. And if you're saving into a Roth IRA, there's income restrictions and there's also contribution limits. So a lot of my clients max out their 401ks in the first couple months of the year, and then they're kind of stuck because they don't have anywhere else to put their money. Well, there's conversions you can do, there's backdoor Roths you can do, there's also some other alternative investments like some real estate that have the same type of tax treatment as a Roth. There's also some non-modified endowment contract insurance that people use as a Roth alternative. The bottom line is, when this money goes in here, we actually go and we pay the IRS in 2022. We pay them that $2,000. So that's going to come out of our $20,000, leaving us $18,000 per year to put into this bucket. The biggest difference is when this money comes out to go to you, it comes out tax free. So you don't have to pay those taxes, which in my estimation are going to be much higher in the future. So the real ramifications are, if you put this money in and you create $2 million of retirement funds over here, but you have to pay 40% of that on the way out because we're in higher tax times, you might end up paying $800,000 worth of taxes. Whereas if you pay the taxes on the way in 2022, when maybe you're in a 20% tax bracket, you're going to pay a lot less in taxes and you're going to have more money. So even though your total account value over here might be lower, maybe 1.8 million, that's all tax free. So you don't have to worry about where taxes are in the future by creating these tax free assets. The bottom line is, by creating proper tax diversification inside your overall financial portfolio, you can have the peace of mind going forward that you're going to have tax-free assets that you can rely on if taxes do go much, much higher in the future. So you'll want to work with your financial advisor or somebody who specializes in tax diversification in order to make sure that Uncle Sam doesn't get a big piece of your financial future. So if you've enjoyed this and feel that it could be useful to somebody else, please feel free to pass it on. If you want to take a quick quiz to see how your overall portfolio is set up from a taxation standpoint, it takes about 30 seconds to fill out. You just click on the link below and we'll get right back to you. Other than that, have a great day and thank you so much for watching. And obviously everything in this video is for educational purposes only, and none of it was intended as investment advice.